Hello and welcome once again to the Costing and Pricing Learning Program. My name is David Gilchrist and this is webinar 10, Ratio Analysis as a Control Tool. Before we get into the main part of the webinar, as usual, I'd just like to remind everyone of the copyright arrangements. These materials are available free of charge to be used in any forum that will help disability service organisations and their staff to be successful in terms of costing and pricing and broader financial sustainability. However, there are copyright arrangements in place and you need to make yourself familiar with those copyright arrangements before you use the materials. Secondly, I'd just like to also remind you of the navigation arrangements. So this webinar 10, considers ratio analysis as a control tool. The previous webinar, webinar 9, looked at solvency and sustainability, and our next webinar, webinar 11, looks at NDIS and frontline staff. It's actually a tool for frontline staff to listen to and to look at the slides in relation to how NDIS might affect them and how it might be explained to help them to understand some of the strategies that your organisation will need to go through. In the meantime, let's get into ratio analysis. I guess there's a couple of major questions to consider before we actually look at how we might calculate certain ratios for disability service organisations. As organisations grow and change over time, no two organisations are the same, and I think this is particularly so in the disability sector in Australia. Indeed, one of the ideas of ratios is that they can be used for direct comparison of organisations, and they can help you to look at figures associated with your organisation, not in isolation but in relation to their relationship with other figures. So in other words, ratios are a good way, shorthand way, of looking at your financial sustainability, your financial performance, and also other aspects of your organisation's operations. They help you to do two really important things. Firstly, they help you to understand what is happening in your organisation today, but they can also be used to develop trend analysis and to look at where things might be heading in your organisation in relation to those particular relationships of accounts. Ratio analysis can be done both from published reports, such as annual financial reports, which you might be interested in if you're looking to compare your organisation with other organisations within the disability services sector. It can also be done internally, and indeed it can be enriched by using internal management numbers that will help you to be able to understand your organisation better. I guess in the context of the previous webinar as well, it's important to know that banks and other lenders will also use ratios to help them to understand your organisation and to ensure whether or not you are able to be supported by them in terms of loans, overdrafts, or any other facility that might be required for your organisation. These will also vary from industry sector to industry sector and sometimes from bank to bank. But the comparison between two direct competitors, for instance, can be a powerful tool using ratios, as can be the comparison of previous periods to the current period within your organisation. One thing that I will return to as we go through this webinar, though, is the warning or the importance of understanding that ratios are only indicators. They're only things that we use to focus our attention on areas where we need to undertake further investigation or where we feel uncomfortable about how our organisation is positioned or its performance during a particular period. Therefore, it's important to remember that ratio analysis is not an outcome in itself, but in fact it's used for directing our precious resources to investigate those areas that we think should be investigated. The main reason for the power of ratio analysis as a tool is that it can reduce otherwise complex questions to simple ones. For example, the question, do you have the right amount of cash, might be a difficult one to answer because of so many different impacts, but also relative to the size of your organisation and many other factors. An easier way to answer this would be to look at the amount of cash held in relation to such things as how much cash is likely to be needed in the near future. A figure that is the current liabilities in the balance sheet. Using the same ratios, you can easily compare the position of one organisation to another simply by doing the same calculation on multiple balance sheets, or watch how one organisation changes or grows over time by running the same calculation for different periods. Because ratios are calculated the same way year in, year out, trend analysis can also be a very powerful tool that we use. Remember though, only 3 periods or longer constitutes a trend. So where you see 2 ratios end on end, that is one period and then ratio for another period, then that is not really a trend. We don't really understand where the organisation is headed in relation to that ratio. What does make us comfortable though is that a ratio analysis for periods of 5 periods or more is much more likely to be indicative of a trend in your organisation. So ratio analysis is very useful for a number of reasons, as I've just outlined. It provides numbers that can be directly compared to each other. It's a common language, and indeed most accountants, most businesses, most organisations across the public sector, commercial sector and not-for-profit sector use ratios in one way, shape or form. It can highlight issues early for you, particularly in relation to trend analysis. We don't want to wait until we're in trouble before we react. And it can also bring out existing issues that are not readily understood. Most importantly, as I said before, it focuses your attention. But as I said, it is only the start. Ratios are indicators, not ends in themselves, and so you need to ensure that your ratio analysis is going to make sense to your organisation. I guess the final point is, before I get into these ratios, which are fairly standard ratios, is that you can create ratios of your own volition within your organisation. So the types of ratios that might be valid in your organisation might not be particularly interesting to other people in other organisations. There are, though, a few ratios that are commonly used in disability services. These are reproduced in these slides. They are also reproduced in the seminar materials, but more importantly, they're also on the Costing and Pricing Learning program webpage, which is cplp.nds.org.au. And they're there in the form of the NDS readiness materials. So make sure that you have a look at those readiness materials before you move forward with any ratio calculations of your own. The first of these is a measure of the proportion of total revenue received from government disability funding, and possible values of course range from 100%, where you might have a disability service organisation that only receives funding from government sources, through to 0%, where no disability services are funded for your organisation. Obviously, most organisations sit on this spectrum it's somewhere in the middle, but have a mix of funding opportunities. The idea of identifying the disability revenue concentration ratio is to help you to understand the extent to which you are vulnerable to government policy change in this particular area. And obviously, given, for instance, that we are entering into the NDIS regime and person-centred care, individualised funding, this would be a fairly important ratio, I think, for most disability service organisations. The objective, of course, being to try to get as balanced a portfolio of income streams as possible to ensure that you're not overly vulnerable to one particular income stream. I guess the other thing, just to close the loop on this particular ratio that's important to remember, is of course that the disability revenue concentration ratio could just as easily be a revenue concentration ratio looking at any other aspect of revenue. So whether it's aged care or some other aspect of revenue that you might have, obviously the ratio is able to be used to look at that too. As with all ratios, and this is a really important point, it is not simple to say what is optimal and what is not. It's very much organisation specific, and it's very much focused on what your organisation believes to be the most important target for these ratios. However, there's two things to say about that. The first is that once you understand what the ratios produce and you agree that those ratios are pertinent to your organisation, in other words, they will help you to understand your organisation and they're relevant to you, then the second element is that you must identify a target for those ratios. So the pure calculation of the ratios is an important aspect, but being able to compare that calculated ratio outcome with your expectations or targets for a particular ratio is of course extremely important. The second ratio that's included on this particular slide, the profit or surplus margin, is also an important consideration. When you go back to the previous webinar where we talked about solvency and sustainability from a financial perspective, of course all organisations within the disability services sector must achieve a profit at the aggregate level in order to be sustainable in the medium and longer term, if not only in the short term. Therefore, this profit margin formula is a really important one for organisations to look at, and obviously you calculate your actual profit margin but compare that to your expected profit margin, and that profit margin ratio then becomes a solid target which can be used to strategise against. Again, there is no one universal indicator of what is an appropriate profit margin and what is not. However, there are a couple of things that you need to remember. Firstly, all of your capital grants need to be taken out of your revenue line in order to be able to calculate this particular ratio. And the idea here is, of course, that capital grants from an accounting standards perspective tend to be taken up as income, but don't represent income because they're usually provided for particular services and can't be used for general expenditure cover. Those two ratios give you both a revenue, a risk ratio in terms of revenue concentration, and a profit margin ratio looking at your performance as an organisation. How about from a balance sheet perspective? There's a number of ratios that are traditionally looked at from a balance sheet perspective, and remembering the profit and loss or the income statement identifies our financial performance for a period, while the balance sheet indicates our financial position. And in many respects our financial position is the most critical because that's the position from which we need to move to ensure that we remain liquid, but also that we remain solvent and financially sustainable into the future. The current ratio, which is pictured here on this slide, is one of the most commonly used ratios in financial analysis, as it's a very useful way to look at short-term solvency. In essence, this ratio provides an answer to the question of whether the organisation is likely to be able to pay its debts as and when they fall due during the next 12 months. If current liabilities are greater than current assets, then those charged with financial responsibility should be monitoring the situation very closely, as this can be an indicator of weakness. On the other hand, if the ratio is too high, then it may indicate that there are better uses for the funds of the organisation, as there are a lot of cash assets being held in the short term. Now, a couple of things that might be important there is to consider in terms of what makes up the current assets and current liabilities, particularly in terms of current assets, where you have income received in advance, you do need to include that as a current liability, particularly because it might be repaid on the chance that you're not actually able to undertake the services for which that income has been provided. Pardon me. The second ratio that's provided here is months of spending. It's a less common ratio. It's more common within the broader not-for-profit sector than, say, in the commercial or government sector, but it can be a good indicator of the amount of working capital that your organisation has in place. As with the current ratio, this is a difficult ratio to get right, and it's always a question that is asked about how many months of spending should we have in reserve, should we need to access that spending, or should we be defunded, or should some other issue occur. The key, I think, in terms of answering that particular question is to try and to determine that if you were defunded, how long it would take for your organisation to make an orderly withdrawal from service delivery. In other words, how many months would it take to wind up your organisation in a solvent way to ensure that all of your debts are extinguished, and also to make sure that staff and other concerns are paid out correctly for your organisation. Clearly, current assets minus current liabilities divided by total expenses minus depreciation is the formula that's identified here. The reason we take depreciation out of the mix, of course, is because we're looking at months of spending. In other words, how much cash do we need to be able to operate our organisation for a month, and then how many months have we got available to be able to push this forward. Total expenses is for the year, so you can do it current assets minus current liabilities. Total expenses for the year gives you that that calculation. Let's have a look at some non-financial ratios. Now, actually, I'm sorry, let's have a look at some debt ratios. Debt ratios, of course, are also an important consideration, particularly given that we had our discussion in the last webinar regarding solvency. But debt ratios help us to understand the extent to which our total assets outnumber our total liabilities. In other words, the extent to which our debt is being covered by our assets, and therefore to give us a sense of the safety of the organisation. So a high ratio in terms of the debt ratio indicates a safe organisation in the sense that you have more assets and liabilities, and should push come to shove, you would be able to realise those assets in order to extinguish your liabilities. Now, there's a couple of problems here. The first is, how do you actually value the assets? And so while you might have, say, assets on your balance sheet at cost, it might be that in fact those costs won't be realised if you had to sell the assets, and therefore you need to be very realistic in terms of the debt ratio to make sure that it means something to your organisation by valuing your assets at what you could actually receive for selling those assets, as opposed to what they might be sitting on your balance sheet at. The debt to equity ratio, on the other hand, looks at how much debt you have against the net assets of the organisation. Now, this is a less popular ratio, particularly in the not-for-profit sector, because equity is not really an indicator of shareholder wealth so much, but rather it's an indicator of just the, if you like, the cumulative operations of the organisation over its lifetime. Therefore, the debt ratio is probably more attractive to most people involved in disability service organisations than the debt to equity ratio. Let's have a look at some non-financial ratios. So I mentioned very early in this webinar that ratios often include financial data or use financial data to calculate them, but they can also use non-financial data, and they can use mixes of financial and non-financial data in order to arrive at ratio calculations that are most useful for your organisation. Therefore, we've got some non-financial ratios here that may help you to understand how well your organisation is operating. There are several leading indicators of employee stress that are commonly used in board and management reports. For larger organisations, particularly those over 50 FTEs, say, the employee turnover ratio can be extremely useful. Under 50 FTE, it might be a little less useful, just simply because there's less statistical accuracy for employee numbers under 50. And also, of course, if you had, say, 10 employees and 1 employee left, that would have a much larger impact potentially on your organisation than if you had 100 employees and 1 employee left. Again, it is up to you to experiment for what is relevant to your organisation. However, the employee turnover ratio pardon me, can be useful. It helps organisations to understand exactly when employees might leave the organisation, what level of turnover there might be, which will also inform things like how much cash you want to set aside for employee entitlements, as well as how much it might cost you to replace those employees in any given year. So the employee turnover is a good indicator of not only the employment, or rather the employment workforce of your organisation's health, if you like, but also as a good indicator to help you to budget and to cost and price your services. Sick leave ratio, of course, is also an important indicator from a management perspective. It helps as a leading indicator of employee stress, and often also as a lead indicator of employee interest in the organisation or in attachment to the organisation. It is, of course, also a good ratio to help you to calculate your cost of services and to make your provisions, as I mentioned before, in relation to employee turnover. I guess the final point is also an interesting point, utilisation ratio. This ratio is used to help you to indicate the percentage of time your client staff are spending actually delivering services. As with all ratios, the components and the definitions are entirely up to you, and they should be developed in accordance with what is most appropriate for your organisation, what kinds of information is going to help you to manage. However, as with all ratios, they are indicators only, and they are designed to help you to identify key issues so that you can then move on to actually finding out the causes of the particular deterioration, say, in the ratio, or even if the ratio is extremely good, often it's worthwhile investigating to make sure, A, that you've calculated it correctly, and B, that data is being collected correctly within your organisation. There are some other issues, of course, that also need to be discussed. We've just looked at some key ratios that are commonly used in the broad not-for-profit sector and more broadly in financial services or by accountants. They're fairly common normal ratios, but there are many ratios that may be of interest to your organisation, and it's incumbent upon you, of course, to explore ratios and the types of ratios that are commonly used in order that you can actually decide what ratios might be of value to your organisation. They vary from organisation to organisation and industry to industry, but importantly, you can also develop your own ratios. You can develop the ratios that are most important for your organisation. You can also, monitor other information, including actual versus expected costs, actual versus expected activity levels, and timing of those activities. Remembering, of course, in terms of costing and pricing, the actual versus expected costs, activity levels, and the timing of those activities is critical to ensuring that you're recovering all of the costs associated with your operations. I guess the final point in relation to ratios to consider is that you need to work out how often you should be preparing those ratios and what that level of data in relation to those ratio outcomes need to be pushed up the line ultimately to the board. There may be some key ratios that are good management ratios but not really relevant to the board. That concludes this webinar. So we've just looked at ratio analysis in the context of disability service organisations. The next webinar, of course, is NDIS for frontline staff, as I mentioned before. And as usual, we're very, very keen to ensure that you're able to contact us and talk to us should you have any queries or comments in relation to this webinar or any suggestions for future content for the webinar series. Thanks very much, and talk to you next time.